Well, I'm going to start this week as your stock our take segment with Descartes, a systems group, the Descartes Systems Group, symbol DSG on the TSX, trades around $170, $14.5 billion market cap. What does the company do? They're founded in 1981, based in Waterloo, Ontario, provide SaaS logistic and supply chain software management solutions for distribution sensitive industries around the world. The company operates a transactional network called the Descartes Global Logistics Network, which provides electronic document exchange across various transportation modes and between enterprises. Descartes Global Logistic Network has over 200,000 connected parties in more than 160 countries and performs approximately 19 billion transactions per month. In addition, the company's transaction network, to its network, the company provides value-added applications on top of transaction network for 5 segments in the market: mobile and telematics, transportation management, custom and regulatory compliance, forward and broker enterprise solutions, and trade content. Let's look at how the stock has done over the past year. Up around 50% the year, powered by a hot tech market and solid quarterly numbers. So let's take a look at the company's last quarter. This would be Q3 fiscal year 2025. Some of the highlights here: revenues were up 100 to around 17% to 168.8 million. They were comprised of service revenues, about 149.7 million. That's 89% of total revenues. Professional services and other revenues of 15.6 million. That's 9%. And license revenue of 3.5 million, 2% of total revenues. In the quarter, service revenues, it's by far the largest portion of revenues, was up 15%. Cash provided by operating activities was up 7% to 60.1 million. Net income up 38%, and earnings per share up around 35% to 42 cents per share from 31 in the same period of last year. Cash on the balance sheet as at October 31st, Halloween 2024, Descartes had 181 million in cash, which decreased by about 71 million from Q3 of fiscal 2024, I believe. Now, why did it decrease? Well, the company does significant M&A activity. Let's not look at that. Significant M&A activity. It acquired a company called My Carrier Portal on September 17th, 2024. They acquired this company, which provides carrier onboarding and risk monitoring solutions for the trucking industry. The purchase price of the acquisition was approximately 22.5 million net of cash acquired. The company also on October 11th made a more significant acquisition of a company called Seller Cloud, a provider of omni-channel e-commerce solutions. The purchase price for the acquisition was 110.2 net of cash acquired. Significant M&A activity has occurred through Descartes over the years. 1.6 billion of capital on 50 acquisitions since 2009. Management continues to communicate that the company has a large M&A pipeline, and the available financial resources suggest that additional acquisitions are possible over the next 12 to 18 months. Net cash, like we said, fell there, but it still has significant cash with that net cash position, about 350 million untapped credit facility, and an estimated about 275 million in free cash flow that we expect over the next 12 months. Valuations here: the company is not cheap. On a trailing basis, they trade at about 75 times EPS. If we look at next year's expected fiscal 2026 expected EPS, the company is expected to grow earnings at about 21.5 times. Then it's trading at around 60 times that level. The PE ratio over the last 10 years on average is about 76. The current PE is slightly lower than the 10-year historical average, but it is its highest point over the past year. There may be a pullback at some point, particularly based on the fact that it trades at 49 times expected free cash flow. That is near or at all-time highs for the company. So in conclusion here, Descartes is a high-quality SaaS business with a solid balance sheet and a strong track record of compounding capital both organically and inorganically through M&A. Long term, we believe the company can continue to create shareholder value through smart, accretive acquisitions, organic growth in the high to single digits level above its historical averages, and with margin expansion and resulting free cash flow growth. While a defensible long-term holding, looking 3 to 5 years plus forward, the stock is trading for higher relative valuations in a pricey market generally. We like the business long-term, but see it as priced closer to perfection in the near term. We're monitoring it for potential entry points if we saw a significant 15 to 20% plus pullback.
This has been one of the big Canadian technology success stories. I think the company's been around for a while. We've always have had a lot of questions from it. Every time I've looked at it, the financial performance has been pretty good. The issue has always just been valuation. It's always, I felt, been priced to perfection.
Yeah, and it's true. I mean, it's right now on a free cash flow basis, it's even literally at its highest point in its history. So you got to take that into consideration if you're thinking of deploying right now capital into this company. It's a really great success story, really great organic grower growing above the industry organically, which is great. And then they've been able to supplement that with smart M&A that grows the company beyond its organic growth rate. If you could see a significant pullback, and people think 20% pullback, how could that happen in a great business? It happens all the time, not every day or anything like that, but it happens significantly over a business cycle or a cycle of a year, even to 2 years. And, we would rather have it pull back where we had a little bit more margin of safety in the company. And then we would, look at deploying in a company like this because it is a good, solid, long-term business. But we can't just pay anything for the stock.
Yeah. I've said it on the podcast before, and I'm sorry for the people that have already heard me say it, but this is a Peter Lynch quote. He says, "Wonderful companies become risky investments when people overpay for them." And like what Ryan was just saying, like, this is a good business, but Peter uses again the example of McDonald's as an example, where in 1972 the stock was bid up to about 50 times earnings. But with no way to live up to these expectations for growth, the price fell from $75 to $25, which he then said a great buying opportunity for a great business at a more realistic 13 times earnings. So again, this is just to kind of put it into perspective what we're talking about.
And just on Ryan's saying that falling 20%, it did even happen for Descartes. In 2021 to 2022, it fell about 35%. So there's your example right there, even it being the exact same business.
Particularly, again, not specifically in its end markets facing weaker, but there is weaker economic conditions, at least in Canada. In those conditions, do you want to pay an absolute premium for a stock? If you're looking 10 years out, perhaps. If you're looking a year out, it's a risky proposition in the near term. It's riskier.